this happy note, I would like to begin. My thesis is financial stability and capitalism will not always be at odds. The reason why the opposite is not true is because the premise that we do not learn from our mistakes is wrong. I use the general conceptual analysis to define the terms of the debate. I imply indefinite time scale. I assume liberal market economies, and financial stability depends on interconnected economic stability and sound monetary policy. But more importantly, it's the bubbles with substantial collateral damage. I argue that economic fundamentals shouldn't pose great threats to financial stability because our economies are not expected to shrink in the foreseeable future, and also if we believe the rational expectations hypothesis, all assets are priced equally, reflecting all available information. In regards to monetary policy impact on financial stability, we have tremendous expertise. We set interest rates brilliantly using forward guidance and quantitative easing, and at the same time, as discussed by Paulina last week from Golf's paper, central banks have impeccable reputation in terms of regulatory pressure, regulatory capture, and use of relevant models. So I argue that we do learn from our mistakes and we get better and better every time. So I say that what did previous crises teach us? Tools at our disposal during the crisis, and have we devised a safer system after the crisis? So let's look at the Great Depression case. The mistake was that the money supply was allowed to contract because the deposits component fell. Also, the disruption of credit occurs because numerous institutions were allowed to go bankrupt, and the financial accelerator effect also exacerbated the problem. But look, we have learned a great deal from the Great Depression. Firstly, we now know that we should defy conventional orthodoxy with creative and innovative methods, such as, during the Great Depression, abandoning the gold standard. And also, from Friedman and Schwartz's book, we should extend liquidity during the crisis to solvent financial institutions that face liquidity pressures. That's essentially the cause of the Great Depression from Friedman and Schwartz's book. And also, Bagehot dictum says that central banks should lend freely at a higher interest rate against good collateral, fulfilling their functions and as the lender of last resort. The Great Recession of 2008 had different pre-developments, including the rise of money market funds with billions of dollars borrowed overnight, post hoc interventionism ideology dominating the central bank's thinking, that they more concentrate on inflation targeting as opposed to deflating bubbles, and also the global savings glut in 2000s increased demand for dollar-denominated assets. And on top of that, emerging economies like China wanted to promote their trade, to increase their exports by deflating their currency artificially, and in turn they had to buy lots of mortgage-based securities and dollar-denominated assets from Fannie and Freddie, for example. 700 billion, can you imagine? Also misallocation within sectors, which allowed bad constructors and good constructors to work at the same time. So these developments led to the increased demand for innovative financial products, which gave rise to credit default swaps, securitization in the form of mortgage-based securities, short-term incentives gave rise to aggressive leverage, and credit agencies valued very highly those complex financial products. As a result, the contagion spread to balance sheets across the world, and systemic risk occurred. The problem was people couldn't tell how much assets on their balance sheets were worth. So we identify clear gaps in our system, and they are lack of clear-cut macroprudential supervision and regulation gaps. So let's look whether we addressed those gaps in the future, because what I'm trying to say that we learn from our mistakes throughout, as our history progresses. Before the crisis, for example, we used expansionary monetary policy, and to a lesser extent speeches like helicopter band speech in 2002 about fighting deflation. During the crisis, look, we have learned the lesson from the Great Depression. We now extend almost unlimited credit to solvent financial institutions, and through discount window programs, emergency lending facilities, we practice conservatorships, market sterilization, private sector solutions like JP Morgan bought Bear Stearns and other examples, government provided loans to AAG, government bailout such as TARP scheme, and interestingly, new innovative measure defying orthodoxy is currency swap lines with other central banks, $500 billion, which allow to ease pressure for dollar liquidity in European and Asian markets. Of course, there were limits to solutions such as an inability to save Lehman, but overall, we have refined our skills in using these highly technical tools and interesting, innovative tools in the real crisis. So, as the time progressed, we have learned, and we addressed the gaps. As I said before, it was lack of macroprudential supervision and regulatory gaps. So, in regards to macroprudential supervision, the good thing about it is that it incentivizes financial institutions to behave well in normal times. And the bad equilibrium never occurs, the bad scenario never materializes. So that's essentially what Ben Bernanke says, that the most important post-crisis reforms seek not to eliminate shocks entirely, but to increase the financial system's ability to withstand them. New institutions hold the system to higher, more resilient standard. To prove it, we have in the United Kingdom Financial Policy Committee, which arguably has a clear mandate for macroprudential supervision. It conducts stress tests around different macroeconomic scenarios. It promotes transparency for markets. Also, importantly, overlap in staff here is viewed as a positive thing because it enhances regulatory understanding, and external members like Donald Cohen guard against groupthink. Though methods of Financial Policy Committee are limited, they nevertheless include power of direction and recommendation within existing legal framework, and knockout notification to the MPC, which shapes their discussion whenever we FPC have some substantial findings. And it has been empirically proven. As for regulation, five major things stand out. Increased capital and liquidity requirements, such as counter-cyclical buffers under Basel III agreement, are now on statute books. It is in law. Then, elimination of regulatory gaps that left major institutions such as AIG, insurance company in the United States, unsupervised. So now those companies are subject to supervision and more stringent criteria. Thirdly, more transparent and safer derivatives trading, improved consumer protection, but to my mind the most important development is the creation of the Orderly Liquidation Authority in the United States. It allows us to dismantle systemically important financial institutions without a risk to the financial system in an orderly and orderly procedure. So this OLA institution solves too big to fail problem to some extent, because companies don't need to grow very big in order to have lower borrowing rates, because government always implicitly guarantees their survival, and also it removes moral hazard in terms of now creditors understand that whatever the size of the company, it can go bankrupt, it can be broken, it can be simplified by the government. So creditors can lose money, which enhances market discipline. So before 2008, regulators failed. The relationship between Ben Bernanke as the Federal Reserve and regulatory agencies and the government provides a blueprint of this new relationship where popular will and technocratic expertise work together. Gardinis in his paper with these two graphs shows how politicians acquired greater say in regulatory and supervision after the financial crisis. Arguably, this system is better because it provides legitimacy, it can dispatch more resources, swift executive action, at least in theory, legitimacy for democracy, and also bargaining with foreign countries for common regulatory frameworks is easier on political level. Of course, I'm not complacent. I understand that the current system is not perfect. There are obvious problems with supervision across multiple jurisdictions. Can it be in the United States or in the European Union, where the ECB has to monitor 6,000 institutions? Of course, fragmentation of regulatory structure hinders the progress, and markets often lapse into rational exuberance. However, the system will get better and better. The best minds are on our side. I've read Ben Bernanke's book over the summer. Honestly, if people like Ben look after our financial system, we are in safe hands. So, we do learn from our mistakes. Therefore, the statement that financial stability and capitalism will always be at odds is wrong, and the opposite is true. Thank you.